TFI International beat management's earnings outlook for Q2 2026. Total revenue came in at $2.29 billion, which is a 12% year-over-year increase, and revenue before fuel surcharge hit $1.90 billion.
Right, and diluted EPS hit $1.65, so that's up 41%, and adjusted diluted EPS reached $1.85, up 38%.
Yeah, and looking ahead, management expects a 350 basis point margin improvement for the logistics segment and a comparable operating ratio for the less-than-truckload or LTL segment.
And as for the stock and capital reaction, the board approved a 4% increase to the quarterly dividend, which brings it to $0.47 per share.
So as retail investors listening to this, our mission today is to tear into TFI's Q2 2026 earnings report, their presentation, and the management commentary to really understand how a physical heavy metal trucking company is operating with the financial elegance of a Wall Street private equity firm.
Absolutely, because when you see a top-line beat like that, I mean, the reflex is just to cheer the headline numbers and move on.
Right, exactly.
But to actually understand the durability of the company, you have to dissect the operational mechanics under the hood. You want to see if this was just temporary macroeconomic tailwinds or if they've engineered genuine sustainable leverage into the model.
Okay, let's unpack this. We established the top-line beat, but we really need to look at which business segment did the heavy lifting to get us there.
Yeah.
And breaking down the report, the truckload segment, TL, was just the absolute standout this quarter. Operating income surged a massive 50% year-over-year to $105.7 million.
It's a huge jump.
It is.
Yeah.
So how does a trucking segment pull off a 50% jump in operating income in a single year without just blindly hiking prices on customers?
Well, what's fascinating here is when you read CEO Elaine Bedard's commentary, it was absolutely not a brute force pricing strategy.
They just leave, right?
Exactly. You can't just hike prices 50% in a competitive freight market. Shippers will just abandon you for a cheaper independent carrier. So this growth was driven by structural advantages TFI has meticulously built over the years. First off, they have highly diversified industrial end markets.
Right.
They aren't purely reliant on consumer retail freight, which, is incredibly cyclical. And second, they are leaning heavily into specialized and flatbed freight.
Which makes perfect sense when you look at the barrier to entry there.
Yeah.
I mean, standard dry van freight just hauling a rectangular box of paper towels down the interstate that's highly commoditized.
Right. Anyone with a commercial driver's license and a leased truck can bid on that.
Exactly. But specialized and flatbed freight is a totally different animal. We're talking about hauling oversized industrial equipment or like 50-foot wind turbine blades, hazardous chemicals.
Yeah.
That requires specific certifications, escort vehicles, and incredibly complex routing to avoid low bridges or weight-restricted roads. So the physical barriers to entry are just significantly higher, which naturally protects your pricing power.
Yeah, you're effectively insulating yourself from that race to the bottom that defines standard trucking bids. TFI is providing a service that their customers just can't easily swap out.
Right.
But the other crucial piece of Bedard's commentary was their internal push to reduce capital intensity.
Wait, how does it do that in physical logistics?
Well, they're optimizing their network to generate more revenue per existing asset rather than just buying more trucks. It means aggressively managing empty miles, what the industry calls deadhead. They use sophisticated routing software so that when a truck drops off a load in Dallas, there's already another highly profitable load waiting nearby to bring back to Chicago. It's about keeping the truck moving and making money.
And the proof that this is working is right there in the adjusted operating ratio. For the truckload segment, that ratio improved dramatically to 86.1%, down from 90.1% a year ago.
Which is a monumental shift in this industry.
It really is.
Yeah.
And just to frame the math for you listening, the operating ratio measures what percentage of your revenue is eaten up by operating expenses. So an 86.1% ratio means for every dollar TFI brings in, they only spend 86.1 cents to actually operate the truck and pay the driver.
Leaving almost 14 cents as sheer profit.
Right, compared to less than 10 cents a year ago. That is raw operational leverage falling straight to the bottom line.
And, this operational efficiency isn't just in the truckload division.
No,
both the LTL less-than-truckload and logistics segments saw double-digit operating income growth, too. Logistics was up 32%, and LTL was up 17%. Plus, management gave some really encouraging commentary on incremental pricing opportunities, specifically in LTL.
Yeah, and the structural moat in LTL is just massive. If you're a shipper and you only have 5 pallets going across the country, you aren't paying for an entire 53-foot trailer. You use LTL. But the carrier can't just drive point to point for that. They have to pick it up locally, take it to a regional terminal, cross-dock it onto a massive line haul trailer with a bunch of other shipments, and then cross-dock it again at the destination.
Right. Which requires a sprawling, physical, hub-and-spoke real estate network across the whole continent.
Hundreds of terminals.
Yeah, hundreds of terminals, thousands of dock doors. The capital required to replicate that network from scratch today is astronomical. It's basically an impenetrable barrier to entry.
So LTL is a heavily consolidated market dominated by a few major incumbents.
Exactly, which explains the pricing power. Shippers can't easily jump to a low-cost upstart because the upstarts just don't have the terminal network.
So all this operating efficiency is generating massive amounts of cash. And here's where it gets really interesting. When you study their capital allocation, TFI operates less like a traditional trucking company and more like a private equity firm.
Yeah, acquiring and optimizing logistics assets.
Exactly. I mean, free cash flow hit $202.1 million for the quarter, up 11%. How are they using that cash?
Well, they function as a relentless roll-up vehicle. They've completed 86 acquisitions since 2017.
86.
Yeah, 86 deals in less than a decade, and 5 of those were major, well over $200 million. But they aren't just empire building. Every single acquisition must be immediately accretive to EPS and free cash flow.
So they aren't buying turnaround projects that'll bleed cash for 3 years.
Exactly. No broken corporate cultures. They hunt for under-optimized but fundamentally profitable regional carriers.
And once the deal closes, they strip out the back office redundancies, plug them into the TFI network, and suddenly that mom-and-pop shop has the purchasing power of an international conglomerate for diesel, fuel, and insurance.
Right. The operating margins instantly boost just by being under the TFI umbrella. It's a textbook PE playbook.
And their ability to convert those earnings into actual cash is unreal. In the logistics segment, TFI is converting free cash flow at an astonishing 98.2%. The peer average is just 79.7%.
And in LTL, they're converting at 85.3%, while peers are lagging at 59.3%.
That 98.2% conversion in logistics is just incredible. In traditional trucking, depreciation is a massive anchor, right? You buy a truck, it loses value, you have to keep buying new equipment.
Yeah, the capital expenditure drag eats your cash.
But a 98.2% conversion means they are turning virtually every dollar of adjusted EBITDA directly into usable cash in the bank, with almost zero CapEx drag. They've engineered the logistics business to be incredibly asset-light.
Right. They own the customer relationships and the routing software, but they contract the physical movement of the goods out to third parties. They take a margin on the spread without ever having to actually buy the physical truck.
Which means minimal ongoing capital to sustain their revenues. And the bottom line for you, the shareholder, is a 10-year total shareholder return of 834%.
Completely crushing the peer average of 574%. They are compounding capital at an elite level.
It's phenomenal. But, no earnings report is flawless. We have to look at the risk management flagged because trucking is an unpredictable, heavy metal business.
It really is.
Looking at the cost headwinds, corporate expenses nearly doubled this quarter. They jumped from $11.7 million last year to $20.9 million this quarter. So what does this all mean? Is this a one-off accounting true-up or a systemic risk for the sector?
This raises an important question, actually. The primary driver of that spike was incremental accident-related reserves.
Oh, wow.
Yeah. To put it in perspective, the operations team brought in $10.7 million in fundamental organic and M&A growth. But a massive chunk of that was completely offset by a $16.9 million hit over the 6-month period strictly for safety and accident reserves.
That is a staggering offset. The operations team is out there grinding out nearly $11 million in new profit, and the liability side just swallows it whole.
Right. It's a stark reminder of the physical realities here. You can have the best AI route optimization and elite cash conversion, but at the end of the day, you still have tens of thousands of heavy steel assets moving at 70 miles an hour down public highways.
And accidents are just a statistical reality.
Exactly. And the entire transportation industry is dealing with these nuclear verdicts in the current legal environment.
Yeah, for anyone not familiar, nuclear verdicts are jury awards in trucking litigation that surpass $10 million. Plaintiff attorneys use what's called reptile theory litigation.
Yeah, they subpoena the entire HR file.
Right, looking for a missed training module from 3 years ago to pivot the narrative from a tragic accident to gross corporate negligence. And that inflames juries and drives those business-ending awards.
And those verdicts ripple outward. Even if TFI has a stellar safety record, the structural inflation in commercial umbrella insurance premiums escalates for everyone. The fundamental cost of just participating in the physical freight market is going up.
which ironically forces mom-and-pop carriers to sell to larger players, feeding TFI's M&A pipeline.
Exactly. But the liability risk still remains for TFI. It's an industry-wide headwind.
And when you're managing that kind of systemic risk, you want a fortress balance sheet. The report notes that net debt repayments actually increased by $117.4 million this quarter, and they reduced share buybacks by $84.9 million.
Which is a highly defensive, prudent decision. With interest rates elevated and liability costs rising, they are prioritizing balance sheet strength over short-term stock performance.
Yeah, rather than artificially propping up EPS with buybacks, they're aggressively paying down variable rate debt. That deleveraging gives them a dry powder to weather macro shocks or pounce on the next major acquisition when a competitor's valuation drops.
It's all about strategic flexibility.
So bringing all this together for you heading into the second half of 2026.
Correct.
TFI International is relying on relentless operational efficiency and a disciplined PE-style M&A strategy to generate outsized free cash flow.
Yeah.
And they're doing this even as liability costs rise in the background, actively deleveraging the balance sheet to maintain their status as a resilient compounder.
They've built an incredibly sophisticated operating machine. Their diversification, their focus on specialized freight, and those asset-light logistics arms provide a very wide economic moat.
But I want to leave you with a final provocative question to ponder. TFI has completed 86 acquisitions since 2017. Every deal must be immediately accretive. But at what point does TFI run out of high-quality, easily digestible targets in this fragmented market?
That's the big question.
Will the pool of cheap regional carriers simply dry up? And if it does, will TFI eventually have to pivot from being an acquirer to strictly an operator relying on organic growth? It's a structural ceiling every roll-up strategy eventually faces. Follow the show for daily earnings coverage.